All right, so what I want to do today is go through a recent blog post of mine called How to Save for Your Child, although it works for parents as well. But it's a side-by-side study comparing two different saving strategies. Um, so I do have a YouTube video I did on comparing all different saving vehicle options and a blog post, so you can go take a look at those if you're interested. But essentially, I rated all the different options, and the top two were a high yield savings account or properly designed high cash value whole life insurance policy with a major mutual company. So there's a lot there. But so what I did with this blog post is I then wanted to compare those top two as if we were saving for a child. So looking at what is the better option. And so what I'm going to do here is just kind of go through my blog um, and kind of walk through all the assumptions and everything I used, and then I'll add a little extra commentary here. So what I wanted to do here, or what I'm not trying to show here, is I'm not comparing. This is not an investment opportunity or anything like that. So I'm strictly comparing two different savings options. Okay. So we're going to be looking just based on these two savings options with certain assumptions. And what I'm using for these assumptions are a child being born at age 1, and the parents in this example are going to be contributing $5,000 per year each year for forever. Contributions start at age 1. There's a 25% marginal tax rate that we're assuming. On the whole life policies, we're assuming a 5% policy loan interest rate. And then these are the different spending things that are occurring over the course of this child's life. Okay, so you'll see there's a $15,000 car purchase at age 16, student loan lump sum repayment at year 23. So this would be like after they get out of college, you immediately pay off all their student loans using the cash savings account or policy. Then we're assuming a down payment on a primary home at age 39, and we're assuming paying for a wedding at age 60. Okay, and these are the values we're using. None of these are price inflation adjusted, and it's not relevant here. And one thing I do want to mention before I kind of continue on, we're looking at expenses in this example, so we're assuming that this saving is just going to be used for consumption purposes. But the same thing would apply if these different spending examples were on investment opportunities, right? So this 15,000 you could think of it as like this was going into a brokerage account to be put in the S&P 500, or it could be used in a private lending, or this could be used as a down payment on a rental home, or this one, same thing, could be a rental property, whatever. These could be investment opportunities as well. And so as you're going through these numbers, consider, and you can pretend that these are used to buy investments as well. And if that's the case, then you need to understand that in both of these situations, we have the same investments that we purchased through either our savings account or a policy. Okay. But in this example, we're using it as, we're going to pretend that it's consumption only. Also, the kids policy is run at a standard health rating, which is pretty typical. Depending on the company, you can sometimes change the health rating when they get older, and so make the policy a little bit better. But these numbers are just pulled from a generic kids policy that I ran, and I inputted the values. So obviously with the policy, there are certain guarantees and certain non-guaranteed assumptions that go into this. So none of this should be taken as a guarantee, like that this is how a policy is going to perform. And the same with the savings, like I'm using an average savings rate in a policy, but that's an average, right? So some years it's going to be higher, some years it might be lower. So these are all assumptions that are baked in here that are going to be off by some variation, especially over a 90-year period. So so just understand that this is really the most important thing here, is just to be looking at the principle of what I'm trying to show here. And base it on that, not exact numbers. Okay. All right. So the first thing I wanted to look at was kind of saving in the vehicle that most people would save in, or they save in something similar to this. And so we're gonna assume that $5,000 is going into a high yield savings account. We're assuming that 2.5% every year indefinitely, plus the taxes. And then in this first example, this is our baseline. So there's no spending occurring. So this is just as if you put the $5,000 in, and you'll never spend out of this account. So essentially what we're looking at this for is to see what is the potential that this savings account could do for us over a 90-year period. And so we scroll down. So just I'll walk through these numbers. So this is the beginning account value. This is how much you're putting in at the start of the year. This is the average rate of return. This is the interest earned on that. This is the tax you'd pay. It'd come out of the account, and this is your end of year. And so then that's just the same for every year. We fast forward out, and you'll see here I have it broken down. In year 1, you have 5,094. Year 10, 55,457, and so on and so forth. So the max potential of this savings vehicle, I shouldn't say max. Obviously, these interest rates, if you go into a high interest rate period, this is going to be much different. But by age 90, given these assumptions, you'd have 1.17 million saved up in this account at age 90. Okay, and this is the typical way that people would save, right? They're putting money into a savings account. Maybe it could be a money market, whatever it is, but most people are going to put money in their savings, and then they're going to spend out of that. Okay, but no spending has occurred yet. So then we're going to compare this to a properly designed whole life policy for a child, again, with no spending occurring from the policy. So now we look at this. So the difference here, so again, starting with 0, you're paying $5,000 in premium into the policy, and you see in the first 4 years, it's negative, right? There's a negative balance. So for a child's policy, you typically will see 3 or 4 years of negative, the first, after paying premium, right? So in an adult policy, if it's designed correctly, there should only be 2, maybe 3 years negative. This is basically your administrative costs, your mortality charges, your commissions, all things like that are baked into and front loaded in these policies. So in year 1, you see that you put in 5,000, but your balance in the account is only 3,018. Okay, and so you have some negative years up front, and then if we scroll down, you'll see the comparison here. So we're comparing it to the previous savings account option. And so in year 1, you'll see that if you compare the life insurance policy here at 3,000 compared to the savings account, which is 5,094, you see that it's negative 2,000. So we're down 40%. By year 10, we're close to break even. At year 11, it's break even. And then you see by year 25, the life insurance has, again, assuming all these different assumptions, which are not going to be correct, but based on these conservative assumptions, the life insurance would have around $57,000 more than the savings account. By year 40, it'd be about $282,000. By year 65, it's 1.7, and by age 90, you have 6.7 million more in savings than you would if you'd use the high yield savings. Now, how does that work? I should kind of explain that here. So a couple things. The medium to long-term growth of a properly designed policy is going to be higher than the typical savings rate. So one, you're going to get a higher internal rate of return on cash in the policy over the medium to long term. In addition, just because of the way life insurance is treated, this, as long as you do it all correctly, it's tax-free growth. So you have tax-free growth. So you're not paying taxes on this growth each year. And well, those are the 2 main factors that are affecting this right now. Eventually, you'll see that there's a third factor, which I'll get into here in a minute. But that's essentially why. So better tax treatment, higher internal rate of return compared to a typical savings account or typical high yield savings account. All right, so you see that over the long term, obviously in a properly designed policy, you're going to have a significant increase in saved capital. Okay, and now what we're going to do is like, okay, now that's great, but what happens if we actually spend this money, right? Because almost nobody's just putting money in a savings account and doing nothing with it. So what we're going to look at here next is a high yield savings account with spending, using those spending assumptions that we mentioned earlier. So the $15,000 car purchase, the $100,000 student loan repayment, etc. And so what we'll see here, and one thing I should mention, just because this account goes negative because we spent the money faster than it was being earned, so it does go negative. So at some, they would have had, in this example, you'd have to put an extra 25 grand in the account just to bring it back up to even. But so what I want to point out here is, you see this number down here says 340. This is the total amount of spending based on our assumptions, right? So if you add up the wedding, the down payment on the home, the student loan repayment, and the car purchase, this person would have spent $340,000 in the course of her life on these 4 large purchases, okay? And I want you to appreciate, because this is that third thing besides the internal rate of return that you're receiving and the taxes, the biggest expense here, or one of the, probably one or the second biggest expense, depending on your tax rate and everything, is what's called your opportunity cost. Okay, so your opportunity cost in this example is this column here. So this is your annual interest cost. And what I'm talking about here is, this is your lost opportunity cost from spending this $15,000 or this $100,000. Okay, when you spend this $15,000, it is no longer in the account earning the 2.5%. And obviously, if this was if we were in a 5% interest rate period, then your $15,000 is costing you 5% return of what that $15,000 could have been earning for you had it been left in the account. And so what this column is showing you is what is that particular year's lost opportunity cost. So you see here it jumps up 2,200 almost. That's from that lost opportunity cost again. Okay, and so you see over the course of this period of time, by age 90, that $340,000 cost you an additional $600,000 in lost opportunity cost. And so you can see it down here. So now the number in parentheses, so this here, is being compared to the high yield savings illustration. So that first illustration that we ran, where there's no spending that takes place. So obviously there's no additional changes in year 1 through 10, but then we buy the car, then we do the student loan repayment. And so you see that by year 25, compared to the original illustration where we didn't spend anything, we have $123,000, almost $124,000 less than we did in the original high yield savings example, even though we only spent $115,000, right? So $100,000 student loan repayment, $15,000 car payment. So yet we're down $124,000. So you can see there that our opportunity cost by year 25 is $9,000. That's what that 115 could have been earning us had it been sitting in the account. And then when you fast forward out to age 90, this is where our account is at 231, but we have $943,000 less than we would have, despite only spending $340. And that's where that $600,000 opportunity cost comes into play. So by having taken our money out of the savings account and spent it on those purchases, it would cost ourselves $600,000 in an opportunity cost. And so that is a significant expense that most people don't think about when they're spending their savings. And so then we compare it to a properly designed whole life insurance policy with loan repayments. Okay, so now in this example, we are going to use our whole life insurance policy, and we are going to use what's called policy loans from our policy contract to purchase the same things in the previous example. So the same car, the same student loans, etc. But in this example, what we're doing is we're not actually taking our money out of our life insurance policy. So a lot of people, if you hear some people talk about this strategy, they'll say like, oh, we're borrowing from ourselves. You're not actually borrowing from yourselves. What you're doing is you're going to the insurance company and you are using your cash value in your policy as collateral for the policy loan from the insurance company. And they will then charge you an interest rate to do that. So interest rates vary. Policy loan interest rates will vary. I'm using 5% here. And so what we do then, what that allows us to do, to take our policy loans, in this example for the car, we're taking a $15,000 policy loan. Our cash value in the policy, right, would have been $108,000. And so the insurance company says we could take up to $108,000 via a policy loan, but we're just looking for 15. So the insurance company's like, yep, here's $15,000, shows up in your account 2 or 3, well, depending, 2 to 4 days later, let's say, and you now go buy the car in cash with the proceeds from the policy loan. Now, again, they're going to charge you the interest rate. So that's what this interest costs. This is your annual interest that you're going to be paying to the insurance company. This does not go back into your policy. Another common misconception. This goes directly to the insurance company. Okay. But what occurs is, even though you access this $15,000 via policy loan, your policy cash value continues to grow as if you had never touched it, because you never did, because you're leveraging it for the loan. And so the policy continues to grow as if, so it's still growing in this example at, say, a little over 4% per year. So you're continuing to get that growth even as you use the money and you pay it back, right? And as you pay it back, it just boosts your cash value back up. And then we do the same thing with the next loan and the next one, right? So the same as now your interest cost that you're paying, so that by the time you're age 90, for the same $340,000, you paid the insurance company, again, this is not going back to you, but in this example, you've paid the insurance company almost $150,000 in interest. And so a lot of people will be like, well, why am I doing that? Why am I paying an insurance company to have access to my own money? And one of the various reasons why that's beneficial is, then if you look down here, now we're comparing this to the high yield savings previous example, and you see that the benefit here is that by age 90, we have not disrupted that compound growth curve. So even though we paid $150,000 in interest over that 90-year period to the insurance company, we are now $7.7 million ahead over 90 years compared to the high yield savings example. Or a more meaningful number might be, by year 40, we have an extra $460,000 in our savings. At age 65, we have an extra $2.3 million, right? So, and that's because we didn't disrupt that compound interest curve. So even though we did have to outlay $150,000 in interest expense, we ended up capturing, because of compound growth and not interrupting it, we ended up capturing $7.7 million over the course of our life. Okay, so that's a significant difference, and it's worth the $150,000 in interest paying to the insurance company. Now, some people might be like, well, hey, that's not really a fair comparison, because you're not comparing apples to apples. And that's true, so I'm going to explain that here in a minute. And what I mean by that is, some people are like, yeah, but you're paying the policy loan, you're putting money back into the account, into your policy. So it's not the same as the previous example where you're spending and not putting money back in your savings account. And that's very true. So we're going to look at that next. But what I wanted to illustrate here is, typically that's not how people run their finances. If they are using a savings account, they're not thinking of that, in this example, $150,000 down payment on the house, not thinking of that as an expense that they then need to pay back to themselves. Okay, that's not how most people are thinking when they kind of do the traditional financial advice or strategy. Whereas the typical person who is using a policy understands that there's a cost to that, and it allows them to build in habits, so they start paying themselves back. And so this is more a psychological way of doing it. So you can so again, usually if people are using a properly designed policy, they understand that I need to be paying these loans back to myself. And so that's why I'm comparing these two, because that's a more accurate comparison of how people use these two different strategies. But for the sake of comparing closer example to each other, what I did here is I then said, okay, well then let's look at a life insurance policy, but with no loan repayments. And then we're going to compare it to a high yield. So then this would be compared to the previous example of the high yield savings with no money going back into the savings account. Now, in this example, you would never want to do this during the accumulation phase of your life. The only time you would want to take out policy loans and not pay them back might be in retirement, when you've planned for it, you understand what's going to happen when you take out policy loans and don't pay them back. So in this example, I couldn't get the software to do exactly what I wanted, but what you would at least do is pay the interest each year and not let that balance compound on itself. And so this would just stay as a flat $340,000 in total loans, and you would just be paying the interest each year. But so what I'm doing here is not, so this would be like worst case scenario where you're not paying the interest on the policy loan and you're just letting it compound, so that over the period until age 90, you would have paid 5.5 million, right, in interest costs. And so this, just so you understand how that would work, this would assume maybe your death benefit is 8 million or something, 9 million or something like that. This balance would be netted off your death benefit when you died. But in this example, you can see that after 90 years, we still have 2.35 million. And so when we compare that back to the high yield savings example with no repayment, we still end up ahead. So just not as significantly. So in year 25, we still have an extra 40 grand in our policy. In year 40, we still have an extra 144,000 compared to the high yield savings. In year 65, we have a little over 700,000, and at age 90, we still have 2.1 million more than we otherwise would have using the typical strategy. Again, you would always want to play honest banker with yourself. You would want to structure these loans so that you're paying them back. But just so you understand, like, this is kind of a worst case scenario. All right, so then what I wanted to do is, okay, now let's compare the high yield savings with repayment to using the life insurance with policy loan repayment. And so what I'm showing here is us, same $15,000 of spending for the car, same $100,000 student loan, etc. But now we're just going to pay it back over a given period of time. So this is saying $3,000 a year for 5 years, and we paid back the full $15,000. Okay. Now there's nothing additional happening here, except I just want to point out this column is just showing you what your opportunity cost was that year. Okay. Or yeah, your total opportunity cost was. So, and then what we're going to do, again, same spending, same everything, payments going back, your opportunity cost. And then this is what the difference is between the two, right? So this is comparing it to the whole life example and with policy loan repayment. So in year 25, you're still down 58,000. In year 40, you're still down 300,000. Year 65, you're still down 1.8 million. And at year 90, you're down 6.8. So slightly better than had you not refilled your savings account, right? There's still an opportunity cost that's occurring there. And so essentially that's what I want to kind of show here, and how you can kind of compare the two. But I do want to mention a couple of things that I didn't cover in any of this, but with the properly designed life insurance policy, you also have these other great advantages, right? You have a tax-free death benefit. Depending on the company, you might have a long-term care rider or critical care rider. There's tax-free income in retirement. You could use the cash value in the policy as like a volatility buffer, or it could allow you to, allow your child to something called the covered asset strategy, and improve income from other assets in retirement. So there's lots of other benefits here. Particularly on a child, you have the protection of the child's insurability. So if they were to get sick or develop some sort of issue that prevented them from getting life insurance in the future, then you would have at least protected them, and they will at least have this policy in force for the rest of their life. There's also other riders you can add on it that guarantees them the right to buy more coverage later in life, even if they do have health issues. And then depending on your state, there's asset protection, things like that. So And then again, I just wanted to reiterate here that these spending amounts, right? So these different things, if you saw them as, or use these different spending as uh, a purchase of an investment or something, ideally that's something that's cash flowing, etc., you can see that it works even if you're buying investments, right? So even if it was to be used to buy real estate, to do options, to buy stocks, whatever, in both examples, your money going in a savings account first and then buying the investments, or your money going into a policy first and then buying the investments, you have the same investments, but with the life insurance, you have more cash value. You have more in your savings than you would compared to if you did it the typical way most people do it. And so it works whether you're buying um, investments or you're purchasing consumption. Obviously, it's better if you're using it to buy investments, and hopefully those investments are sending cash flow back to you, and you're paying your loans off via the cash flow from that. But I just want to point that out that you can have both if you use the life insurance properly. Not to mention all those other benefits. Obviously, if you have a family, having that life insurance is a massive benefit. But anyway, so hopefully that was helpful to kind of go through, look at the numbers, compare the two different options. And again, if you want to look at my analysis of the different savings options, specifically for children, but it's pretty similar for adults too. There's a few different scenarios there, but you can check out the Richest Boy YouTube channel or go to my blog on the topic. But anyways, thanks for listening and have a great one.